Creating a monthly investment plan begins with a clear understanding of your goals and timeline. Take a moment to define what you are investing for: retirement, a home, education, or building wealth, and assign rough target dates and amounts where possible. Having concrete objectives helps you choose appropriate investment vehicles and risk levels, and it makes it easier to measure progress. Without defined goals, it's easy to drift into ad hoc decisions that don't add up over time. Next, get a realistic picture of your finances by tracking income, expenses, and existing savings. Build a simple monthly budget that shows how much you can reliably set aside after covering essentials and discretionary spending. Before committing money to investments, prioritize an emergency fund equivalent to 3 to 6 months of living expenses and address high-interest debt. These steps protect your investment plan from being derailed by unexpected costs or costly interest payments. With your budget and emergency cushion in place, decide how much to invest each month and allocate that amount among different goals. Use a practical rule of thumb, such as setting aside a fixed percentage of income, but tailor it to your priorities. Divide contributions between short-term and long-term goals. Keep near-term targets in liquid, low-risk vehicles and channel long-horizon goals into growth-oriented accounts. Be realistic. Consistency and sustainability matter more than maximizing contributions sporadically. Determine your risk tolerance and time horizon to guide asset allocation. Younger investors with decades before retirement can typically tolerate higher equity exposure for greater long-term growth, while those closer to a goal may prefer more bonds or cash equivalents to reduce volatility. Your temperament matters too. If market swings trigger anxious selling, a more conservative mix will likely help you stay the course. Aim for a diversified portfolio that mixes stocks, bonds, and other assets to smooth returns and reduce single-source risk. Choose investment vehicles that match your goals and tax situation. Make use of tax-advantaged accounts like IRAs, 401ks, or education savings plans when applicable, and consider low-cost index funds or ETFs for broad market exposure. For monthly investing, automatic transfers into brokerage or retirement accounts make the process effortless and enforce discipline. Keep fees, expense ratios, and tax consequences in mind. Lower costs compound into better net returns over time. Automate contributions and implement dollar-cost averaging to remove emotion from timing decisions. Set up monthly transfers so you invest consistently regardless of market conditions. This mechanism not only builds assets steadily but also smooths purchase prices over time. Periodically rebalance your portfolio, once or twice a year or after major market moves, to realign with your target allocation, harvesting gains from overperforming areas and buying into underweighted sectors. Monitor progress and adjust as life changes. Review your plan quarterly or semi-annually to ensure your savings rate, asset mix, and goals remain aligned with changing income, family needs, or market conditions. If you receive raises, bonuses, or windfalls, consider raising your monthly contribution. Conversely, if your situation tightens, temporarily scale back rather than abandoning the plan. Maintain a long-term perspective. Focus on minimizing costs and taxes, and cultivate the habit of consistent investing. Over time, disciplined monthly contributions compound into meaningful financial security.